So let's talk about how to set up your charts. We have a few charting essentials here. First of all, we will talk about the time frame. You know, when you plot a chart, you always need to have a time frame. You need to define whether you have a 5-minute chart, a 15-minute chart, whether you use tick charts, or we will use range bars. And since very few traders have heard about range bars, we'll spend a few minutes there and I'll explain you exactly what it is and why they are so fantastic. The three indicators that we use on our charts are Bollinger Bands, MACD, and RSI. And I'll show you exactly how to set up these indicators. Let's talk about range bars first. See, when you set up a chart, your charting software probably asks you what time frame do you want to use. And this is where you have essentially three options. First, you can elect a time-based chart where you plot, for example, 5 minutes, 15 minutes. And whether you're using bars or candles, you know the concept. So what happens if you're choosing a 5-minute chart is that a new bar or candle forms after a certain amount of time has elapsed. In this example here, 5 minutes. Now, many traders find that time-based charts, there's a lot of clutter on there. There's a lot of noise on time-based charts. And I think, Mark, when was it, 2 or 3 years ago when tick charts became really popular? Mm-hmm. See, many traders 2 or 3 years ago moved over to volume-based charts, also known as tick charts. Who has heard about these tick charts, like 133 tick charts or 300 tick charts? Okay, so basically the idea is that the term tick is a little bit misleading. It should really be called a 133 trade chart, because here's what happens. After a certain amount of trades took place, we are plotting a new bar or a new candle. So the idea with these volume-based charts is that we are taking the time element out of the market and we are plotting more bars when there's a lot of volume in the market, a lot of activity, and we're condensing the chart. We're plotting fewer bars or candles if we don't have a lot of volume, like in the overnight session or during the lunch break. Now, by doing this, traders have been able to eliminate some of the noise that's in the market and get a clearer picture of what's happening. But still, volume-based charts have significant disadvantages. What we have been using for several years now, many years, are volatility-based charts. So what does this mean? Again, you're plotting a new bar or a candle after the market moves a certain amount. Here in this example, 8 ticks. Now, this is where it gets a little bit confusing because the volume-based charts are often used the tick charts, and when plotting volatility-based charts, we are also using an 8-tick range, but we are not talking about trades here. What we talk about is movement, volatility movement. So, what is a range bar? Range bars have a fixed length. When you're using range bars or range candles, it doesn't matter. I'll explain here in a few minutes why we prefer bars over candles. But if you're using range bars or range candles, they all have exactly the same size. They have a fixed length, like here in this example, 8 ticks. So the next bar only forms when the market moves a 9th tick from the high or from the low. See here the first bar? We have the low, and the high will be exactly 8 ticks away, or whatever you define there, or 2 points, or 16 ticks, or 16 points. So we will walk through examples here, and we'll show you the exact settings that we use for the markets we follow.